Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at YCharts. If you're on the hunt for that next big insight, head over to the YCharts blog page and check out their latest piece on the top 10 best performing ETFs of the past decade. This isn't just your typical top 10 list. YCharts goes deep, breaking down what drove these ETFs to outperform, what lessons you can take away to fine-tune your own investing strategies. Plus, you'll get access to downloadable, easy-to-understand visuals that not only elevate your client communication, but also keep your clients and prospects engaged during meetings. Plus, it's customizable, so you can compare strategies across size, style, and sector. Subscribe to the YCharts blog with the link in the show notes to ensure you're plugged into the latest insights, research, and market trends. And don't forget, get 20% off your initial YCharts professional subscription when you start your free YCharts trial and tell them that Meb sent you. New customers only. Welcome back, everybody. Today's guests are Rzym and Tarek Abou, two portfolio managers from Man AHL, one of the largest running systematic asset managers in the world. Today, we're going to talk about a topic we really haven't covered here on the show before, catastrophe bonds. Andre and Tarek are going to give us a high-level overview, then walk us through where the asset class is today, what the future looks like, and what the weather season will be like the rest of the year. Andre and Tarek, welcome to the show.
Hello, everyone, and thank you, Meb.
So we're going to start with catastrophe bonds and sort of that world. This is a topic that I love. So give us the broad overview.
I think rather than beginning with what are catastrophe bonds, I think a better starting point is why do they exist at all? And to answer that question, you really need to go back to 1992 or so, when you had Hurricane Andrew, which made landfall in Florida as a Cat 5 hurricane and depleted something like 10% of insurer capital. In addition, in that decade, you had non-natural catastrophes such as the Exxon Valdez oil spill, and you had growing asbestosis claims. So you have a situation whereby the reinsurance market is getting tight on capital, and it's limiting their ability to write new business. So for that reason, they sought to access a capacity in the capital markets. And the way they did that was through catastrophe bonds. The first deal was launched in 1997, and then it really started getting going, if you like, in 2022 to something like a $45 billion or so dollar market today. So in terms of what they are, in a sentence, they're a securitization of an insurance contract, essentially. There are three parties involved. First of all, there's the investor. So the investor pays some money to buy a bond issued by an SPV, which is set up for the purpose. Typically Bermuda-based, but otherwise Cayman and some other domiciles as well. The SPV will take the cash, the proceeds from the bond, and put it in some very low risk investment. So it's earning the risk-free rate. At the same time, it enters into an insurance contract with the sponsor, and the sponsor will pay a spread. This is the insurance spread. So the holder of the bond is receiving the spread from the sponsor plus the risk-free rate. So immediately you can see that this bond is a floater plus a spread. Now, if there's no triggering event for the insurance contract, then at the end of the typically 3-year period, the investment in the largely risk-free assets will be cashed up and passed back to the investor. So the investor's earned risk-free rates plus a spread, and they're happy. If, on the other hand, the insurance contract is triggered in some way, then some or all of the proceeds of the assets held by the SPV will be passed to the insurer. So that way, the insurer effectively has a fully collateralized insurance contract, so they have no exposure to the investor. And the investor itself also has very little credit exposure to the insurer. Then the question is, well, what do these bonds and by extension insurance policies cover? So we're really talking about what are the perils? And we're talking about things like US quake, US wind, European wind, Japanese wind and quake, and then some more exotic perils, if you like US wildfire, cyber risk, operational risk.
One way to look at the market is to look at a so-called Swiss Re index. And Swiss Re index, think about as this market cap, if you want, similar to the S&P 500 in equities, a market cap weighted index of the overall industry. Now, admittedly, it's not directly investable, but nevertheless, give you a good idea of the space. And this index goes back to 2002. And if you look at the performance of this cat bond index since 2002 till today, you'd realize that you've annualized a return of around 7.1%. To put that in perspective, equities, world stocks, MSCI World, has realized over the same period around 7.3%, which is broadly equivalent, but at a volatility of 14%. Now, the vol of cat bonds has been, if you just do the simple calculation of your standard deviation, we'll talk about the caveat of doing this approach. But nevertheless, if you take a simple approach of looking at the annualized volatility, you're at 3.7. This is half of your annualized return. And now, of course, you can't properly calculate volatility in such an asset class where distribution is more binary than anything else, but nevertheless, give you an idea of the type of return you're expecting, even though you've had defaults, you've had some bonds triggering, you've had some catastrophes happening. Nevertheless, over 20 years or so, they've annualized 7%. Now, what is more interesting as well, Mep, is that if you look at the drawdown of, again, the Swiss Re cat bond index, and the drawdown date goes back, the largest drawdown is minus 9%, and it goes back to 2022 from August till September. Now, to put it in perspective, again, compared to equities largest drawdown was roughly around minus 50% and lasted around 16 months. But also what I like about this approach, about the asset class itself, is that if you look at diversification to equities, it's broadly non-existent correlation to bonds for the simple fact that, as Andre mentioned earlier, these are set up as a floater, meaning that you get your spread, so you get your cash return plus a spread on top. And as long as you don't have a default, you're going to get back cash plus the spread at maturity. So what tends to happen is that if you have an equity crash, putting aside liquidity issues in the market, there's no natural reason for these things to sell off, except if there's a trigger. So this diversification is quasi-natural. It's built in, given they react and trigger to events which are uncorrelated and orthogonal to what you see in equity markets. And of this asset class, it is actually quite large. If you look at the outstanding notional in 2002, 2003, when it all started, at zero, and today we are shy of $45 billion. This is an outstanding growth of a market which is relatively less known, I would say, and a market which brings you diversification to the portfolio as it's linked to outside factors, while at the same time ensuring and delivering historically a return of 7%.
What is the most simplistic example of a setup? So Japanese earthquake, who's buying it, who's selling it? What would be like the most generic trigger?
Just thinking about US wind as a nice generic and common example, who might the investor be? It might be a hedge fund, it might be a pension fund, it might even be a reinsurer. They're buying the bond. It might trigger if, for example, a named storm causes an amount of industry losses within the US. There are two types of measure of the insured losses. One is annual aggregate. This is saying, well, let's add up the losses incurred throughout the year. And if it hits a certain amount, then the bond starts getting eroded. And the other is per occurrence. So if any one single event exceeds a certain threshold, then the bond triggers. So associated with the contract is an attachment point and an exhaustion point. So, for example, you might have a $40 billion attachment point. You might have a 45 billion exhaustion point, just to make some numbers up. And if the incurred losses exceed 40, then the bond will pay out to the sponsor from 0 to 100% as those actual losses approach the 50 billion mark.
To give the listeners an example, like what would be a ballpark yield today here in the summer of 2024? I imagine it's pretty variable, but is there any sort of generic target that you would look for this general class of investments?
They do range in seniority. So if you have a bond whose expected probability of loss is very low, down in the, pick a number, 0.5% or so, something like a 1 in 200-year event, then obviously the spread that's earned is lower than if the probability of triggering is, let's say, a 1 in 50-year event. On average, I would say that if you looked across the universe of bonds, the average coupon is probably something like 8 or so % over risk-free. One measure that people tend to use in this space is thinking about the ratio of the spread divided by the expected loss. So probably on average at the moment, that ratio is something like 4 or so.
It's interesting when you're dealing with these very rare type of events and the pricing of how you go about thinking about the extra juice. It's not that too dissimilar from sort of corporate bonds and how many default versus the yield, but it just happens to involve typhoons and earthquakes and everything else. But if you had to do the kind of pie chart of the perils covered here in 24, what's the general percentages? Is there a breakdown of what's the biggest one covered all the way down?
Yes, I mean, it's the case that the catastrophe bond universe is dominated by two peak perils of US wind and US quake. So something like 70% of the outstanding notional is exposed to US wind in one form or another, and something like 50% of the outstanding notional is exposed to US quake. Now, you might realize that that adds up to more than 100%. And that's because there are some bonds, they're called multi-peril bonds, which can trigger if either there's a US quake event. And then you have smaller perils like US wind, Japanese wind and quake. And then you have what I would classify as being the more novel perils, as I mentioned right at the start. Things like US wildfire, New Zealand quake was a newbie for last year. Cyber was a newbie for the last quarter of last year.
And I assume most of the wind is hurricane. Is some of that tornado too, or is it all just hurricane type of?
It can be either or both.
One of the things investors certainly will have taken notice of is this index just cruising along. Every little once in a while, it's got like a little move down, then it cruises back along. And then what the hell happened in 2023 and 4? All of a sudden, you're having these like 5, 6, 7% returns. And then it's like 20%, I think, last year, roughly, something like that. And then having a great year this year. Talk to us about the dynamics. What's going on?
Yes, 2023 was a strong year. And just prior to 2023, you had Hurricane Ian, which was something like $118 billion loss. So Hurricane Ian did a few things. Firstly, there was a market perception that some bonds would be triggered, and these bonds were marked down. In addition, there was a general, if you like, repricing of risk, a hardening of the market. So even, let's say, a US quake, the prices of those bonds went down and the yields went up as well. Not as much, but nevertheless, there was a general hardening in the market, meaning that prices of most assets went down. So this set you up for the beginning of 2023 by bonds which really weren't any more risky than they were 3 or 4 months ago, having been marked down just shortly before. And they are only 3-year instruments, so they fairly rapidly pull back to par. So you had returns from non-Ian related assets, which were attractive, bonds which had been specifically marked down because of expectations of losses from Ian. it seems as though that was maybe an overly pessimistic markdown. So we saw some recovery there as well.
2023 was a very active year. In fact, in our records, in our database, which go back to 1950s, we see that 2023 was the fourth most active year on record.
In terms of storms, or?
Yeah, was the fourth place in terms of named storms since 1950. Now, if you look at the impact on the cat bond market, was quite remarkably small. And so the first point here, which is quite important, is that even in an active season doesn't necessarily mean you're going to have large losses in the cat bond space. And 2023 was a case in point where you had the fourth most active season. However, we did not have a single large hurricane event, which meant that we did not have single large losses and a write-off of cat bond events. Now, I want to also point to a different year. Andre mentioned, for example, 1992. Well, 1992 was relatively inactive season, and you only had, if I'm not mistaken, a single hurricane, which was Hurricane Andrew, and that triggered substantial losses and record number damages. So the question is not always whether the active season mean active losses, but all you really need is one big hurricane, which is going to cause you a lot of pain. Now, 2005, 2017, again, quite different because they were very active and have led to large losses on annual aggregate and per occurrence basis. So the point really is that this dynamic, this causality between active season and losses is not always there.
Talk to me a little bit about the state of where we are with issuance and demand.
In 2024, I would say, again, it's been dominated by US wind.
From a demand perspective and from an investment perspective, there's an easy way to track at least some of the demand. And you can look at the UCITS funds, Catastrophe Bond Fund asset under management. And today we are at around $12.1 billion. And that compares to 2015 when these things were just shy of $2.5 billion. So there has been an increase in demand. And again, one way to track it is to looking at asset under management in UCITS cat bond funds.
One thing to bear in mind as the market gets bigger, I mean, we mentioned that the size of the universe is about, let's say, 45 billion. If we assume that the average maturity of these bonds is 3 years, you need $15 billion of issuance just to stand still. So the issuance to date won't quite cover the maturities that we're going to see throughout the year. Now, I'm sure in total we'll exceed that. But just to put it's not just a question of new issuance and increasing market cap being one and the same. They're certainly not.
Talk to me a little bit about the investor side. How much does it matter that you read the documents, that you have good models, and how much of it is like, could I be the Jack Bogle of cat bonds and be like, you know what, I'm not going to read any of these. I'm not even going to let ChatGPT read these documents. I'm just going to buy all of them, and I'm going to buy them market cap or equal weight. Is that person going to do okay, or are they going to get their head handed to them?
If you take this approach, you can buy market cap, exactly market cap, and your constituents or your portfolio holdings will be perhaps similar to what you get from the Swiss Re index. Now, there are two issues there. The first one is that the Swiss Re index performance, the pricing is based on mid, not based on bid-ask. So hence you might have a lower performance overall than what you see on screen, which you might say it's fine. I still get kind of a similar performance, albeit a little bit less than the index. Now, the second problem you would be facing goes back to what Andre said at the beginning, which is on the market cap and the market issuance, which is heavily tilted toward peak perils, which are US quake and US wind. 70% is, broadly speaking, is a notional of these two peak perils. So your portfolio would be heavily tilted towards these two peak perils. Now, is that good or bad? It depends. You're not getting the diversification you would be getting if you were to spread your portfolio across a larger pool or a more balanced pool, if you want, of perils, and hence benefiting more from diversification you would get by being in Europe, by being in Japan, by being in other perils, Andre mentioned cyber, and benefit more from that diversification as opposed to be solely focused on these two peak perils.
From if you like, a temporal perspective, imagine next year the issuance of US wind increases still further, if it goes to 80%, 90%, and increasingly dominates the space, is that the exposure that you would like? You might not care, but you're certainly ending up with a more concentrated portfolio. Judging by what one reads in the news at the moment, it does seem as though some investors, and I'm thinking of the CrowdStrike cyber outage that we've had very recently, it does seem as though some investors perhaps didn't realize that some of the cyber bonds are exposed to, if you like, non-malicious cyber events. Again, is it good or bad? I'm not sure that it's ever good. Whether it's bad, you might say, well, I don't care. But I'm not sure it's terribly healthy for the market. It doesn't really encourage rational pricing in the form of a rational demand of the offerings. And I think it, taken to the extreme, it could lead to a degradation of the quality of the offerings for everybody, because some people are just buying everything.
Are you tired of hearing the phrase climate change, or is there another type of word that hits your funny bone?
It depends on the peril, and there's a spectrum. At the one extreme, you've got something like quake, which is essentially indifferent to climate change. Then you've got something like, let's say, Atlantic storms, where there is some expectation of impact from climate change. I have to say, not entirely all in the same direction. So warming sea surface temperatures, all things being equal, is good for the formation of hurricanes. But the other thing that you need is low wind shear. In other words, the difference between wind near the sea surface and wind speeds in the upper atmosphere. And it's less clear what the effect of climate change on wind shear might be. So it's not entirely clear cut. And then you have something like, let's say, a California wildfire, where if you look at losses measured by acres burnt, structures burnt, deaths, you find that the last 10 years or so dominate the statistics, even though the statistics themselves do go back materially further than that. So you're in a position of not really having much historic data that's perhaps relevant to forecasting the future. And I think that does and should be baked into the pricing of, for example, wildfire. In other words, the ratio that I've mentioned numerous times now should be higher in the case of something like wildfire than it should be for, let's say, US quake. Just on the subject of US wildfire, there's diversification within the wildfire peril itself, that some of these bonds are seemingly almost mutually exclusive in terms of triggering or not triggering on one event.
There's a second point which always comes up, which is on slightly related to climate change, which is, are cat bonds perceived ESG, and what's the role of cat bonds in climate change and potentially mitigating some of the impact of climate change? And there's a couple of ways to look at it. And the first one is that, in essence, what cat bonds are, they provide an element of disaster recovery for the insured risk, and thus they are transferring the risk of weather change, of catastrophe risk from the insured entity to financial investors who are, of course, willing to bear that risk. Now, this is the starting point, because once you start looking at the space a bit more carefully, what you realize is also a new breed of cat bonds that has emerged. And these aim to prevent disaster and extend coverage, in particular for low-income countries unable to mobilize proper financing. And to give you just a bit of example on the second point, which is quite key and quite important here, if you think back to the UN, United Nations definition of resilience, and this is a quote I like in particular, they define resilience as the ability of a system or a community exposed to hazards to resist, absorb, and accommodate and recover from a catastrophe or a hazard in a timely and efficient manner. So this is the UN definition of resilience. Now, if you think about this new breed of catastrophe bond which has emerged, and one in particular, or even two, but let's start with one, which is the Turkish catastrophe insurance pool. So Turkey is heavily exposed to earthquakes. They have a low historic insurance take-up, and the reliance on the state is to finance household and reconstruction has been quite high and has taken a substantial burden on state finances. Now, what has been put in place with the assistance of a World Bank is a setup where catastrophe bonds are done to help refinance the reconstruction following an earthquake, and do that in a timely fashion. And you can do it by different ways. You can have a so-called parametric bond, so you know if those parameters were hit. You mentioned, Meb, earlier, if parameter threshold X, Y, and Z has been exceeded, you have an automatic payout. Automatic payout is quite key, in particular in those countries, because they allow you to give you the money straight away, not waiting for litigation, for claims, etc., for overworked, overburdened officials to be able to process all of these. You get access to the money straight away, and this is quite important. A second example is the Pacific Alliance earthquake cover. And this is a World Bank launching 5 cat bonds under its global debt issuance facility for the benefit of Chile, Colombia, Mexico, and Peru. And once again, featuring parametric triggers and helping ensure a speedy payout. Now, in total, there has been $1.3, $1.4 billion issued, and this was the second largest issuance in the cat bond market, specifically to kind of build resilience, manage risk, and have a quick recovery and payout in case of disasters. Now, these are focused on, call them natural catastrophes. There's also, in this new emerging breed, this new type of bonds, specifically pandemic bonds, which try to kind of be helpful in a different way. The payout is automatic, so a set of rules. For example, if this pandemic crosses multiple countries, if it exceeds X, Y, and Z, if you have these specific rules in place and these have been exceeded, you have an automatic payout to help mitigate disease outbreaks. So to make sure if you have an outbreak somewhere, it doesn't become a global pandemic, but it's contained by providing quick access to money to make sure that on-site in low-income countries, you have a quick access to these markets.
A recent one, Jamaican wind bond. Again, the World Bank issued the bond off its global debt issuance facility. Now, any payout that might arise from this bond, yes, it's as Tarek described, it's going to help mitigate stress on the public finances of Jamaica. So that Tarek's covered. One other point to consider, though, is when one buys such a bond, where does the cash sit? Well, it sits with the World Bank. What do they do with the cash? Well, in this particular case, the World Bank specify, and it's not specific to this particular bond, they do it with many, they specify that the cash will be used for eligible sustainable development projects. So even if the bond doesn't trigger and 3 years later the investor gets their money back, there has still been some social benefit from the activity because of the use of the proceeds of that cash in the meantime. And in fact, there's the odd example where the sponsor themselves, an insurer, may say, well, to the extent that I'm able to free up any regulatory capital by this additional cover I buy through this catastrophe bond arrangement, I'll use that for sustainable development projects as well. So there are some slightly indirect benefits as well to some of these bonds.
What are some common misconceptions when it comes to this asset class?
I don't know so much about a misconception, but a way of thinking about value of the space that I've heard from time to time is comparing the yield that you might expect on cat bonds, for example, with a high yield portfolio, some sort of credit basket. It's fine to make that comparison, but you're in danger of not recognizing the diversification benefit that you're getting from catastrophes. Not even so much on a day-to-day basis, because generally one doesn't care day-to-day if there's a small move up or down. What you really care about is in times of market stress, when there's a large sell-off in your credit portfolio, what's going to happen to your cat bond portfolio? Or if you hold an equity portfolio and there's a big sell-off, what happens to your cat bond portfolio? And what you tend to see is that when equities sell off strongly, then conditional on that, high yield's probably selling off as well. But statistically, just looking at weekly returns, what you see is that the cat bond market tends to be pretty much unaffected by these financial events. So I think just to simply compare yields is not the right comparison.
There's one more misconception we always hear about liquidity of cat bonds and a lack of secondary market. And some assume that cat bonds are illiquid and hard to trade. Now, one has to note that if you look within the ILS space, public cat bonds are the most liquid assets. As an investor, you get weekly marks from multiple brokers giving you an indication of pricing on a weekly basis. And perhaps the best way to think about it is to look at, yet again, at UCITS fund. Those have a maximum liquidity of 2 weeks, fortnightly, and trade around a quarter of the market. So cat bonds, different segments of the ILS market, tend to be on the most liquid spectrum, where trade is possible, where you can get multiple weekly marks and sheets. These are all trace eligible. So you see the pricing on Bloomberg, you can see the exact pricing, the purchasing, the selling, and that gives this market a good level of liquidity. But again, there's a second point is liquidity and liquidity stress in markets is not correlated with liquidity stress in cat bonds. So which means that if equities are selling off, it doesn't mean there's any impact on the trading activity or shouldn't have any impact on trading activities on cat bonds, given again as a diversification and the fact they're set up as a floater, i.e. you have a cash and a spread on top. And as long as the trigger has not been attached or there's no attachment for the bond will still trade at par.
When I think of liquidity, I guess it just means, what do you mean when you say liquidity? We recently saw in the United States that a ETF was filed to invest in cat bonds. And I haven't deeply read the prospectus, so I don't know if they're doing it through actual bond issuance or through swaps or something else. An ETF is kind of at the extreme of liquidity where, look, there's all the other type of bonds that ETFs invest in that are probably not liquid at all either for daily regimes and pricing. So who knows? But it's going to be fun to watch. That's for sure. I'm curious to see what's happening there. As we look around the corner, are there any areas of this space where you think, hey, this is a risk that hasn't been adopted by the market as a securitized possibility that we think as we look out 10, 20 years is something that the world may gravitate towards? I feel like natural disasters is the obvious one. And you guys kind of alluded to a few as we were talking about cyber and terrorism. Is there anything else that we're missing? Alien invasion?
I think cyber is an example where we may see diversification as well as additional volumes in the market. But outside cyber, what else might we see? There are some perils which are insured, which you really don't see in cat bonds. For example, where's marine exposure? Where's aircraft exposure or satellites or all the sorts of perils that you see just by casting your eye down the list of things that, let's say, Lloyd's of London would cover. Maybe the question is why, and I wonder if the reason is because the reinsurance market itself has sufficient capacity for those perils, whereas what gets pushed into the cat bond space are perils where the insurance space is getting tight on capacity, so they need to look outside. And to your point about alien invasion, I'm sure there's some coin flipper somewhere within the insurance world who would be happy to take the other side of the bet for you. And there would be no shortage of capacity there, and therefore it wouldn't come to cat bonds. I think it's demand.
You guys spend part of your brain thinking about crypto as well. It's Ethereum ETF week here in the US. So listeners, we're recording this near the end of July. What's going on in that world? Give us an update, or what are you guys thinking about, or how are you thinking about it? How the Brits thinking about it? What's on your brain there?
It's a very exciting space. We saw the Bitcoin ETF attracted a significant positive inflow of fresh new cash, not just grayscale recycling in. It's a growing space. It's still nascent by nature. The applications today are relatively limited on a day-to-day basis for the average user. But however, it's a space waiting for a killer application. And once that is up and running, you might see a space growing bigger and bigger. Today, it's broadly dominated by retail behavior and by retail activity. It's behavioral by nature. Why we look at markets, we look at trading systematic strategies and trading behavioral opportunities. And certainly the market, crypto space, give us quite a bit of flexibility there. It's a 24/7 market. It's a market which is liquid. It's a market which is diversifying to some extent, I would note. Less so today than it was pre-2020, but nevertheless, a degree of diversification is still there. And you have a lot of behavioral opportunities which you can look at exploiting in a systematic way, given, again, the retail nature of the underlying trading market.
It's a matter of what's the actual usage of crypto coins right now? Limited. But I think the other area to think about is what use can the blockchain technology itself be put to? And that, again, is an area of exploration. And in terms of it being an unusual asset class to trade, to me, what's interesting is that the more you try and think as an institution, what do I need? How can I trade this market? The more you realize how much easier it is for an individual investor to access this space than it is a regulated institution. If we decide to open an account in some Latin American country or wherever it might be, there's nothing stopping me as an individual. But that would be a different story were we to try and do that as a regulated institution. There would undoubtedly be questions concerning AML, KYC, and so on and so forth. So I think this gives retail investors perhaps an advantage in a sense, but in any case, it gives rise perhaps to different dynamics than you might see in other markets.
This is the interesting bit for us, because the more retail establishment you have in the space, the more for us as an active manager, the more chances there are to be able to extract some behavioral biases and trade these long and short.
Y'all do obviously a ton of great work in trend following. I keep tweeting new articles from the research department are really well done. But one of the things I always talk about when you look at a traditional portfolio, so Americans listening to this 60-40, but even a global 60-40, and starting to add other. So things that don't correlate, have good returns, that improve that allocation. I know we always talk about trend following and how much it recommends versus how much people put in, if they put in anything, which is usually zero. Cat bonds must really jack up that optimizer. Because I imagine if you were like, all right, I'm going to blind these asset classes and return streams. I'm going to blind everything other than just the risk return metrics. And you put cat bonds as a category with saying there's no capacity constraints. I mean, I imagine it's going to tell you to put in like a quarter of your portfolio in cat bonds. And I can't fathom that anyone puts in more than like 5%. How do you guys think about this in a portfolio optimization context?
I can tell you one approach to portfolio construction is, of course, the traditional one, where you take volatilities, you take return, and do your typical mean variance application. Now, that has its limitation. I mentioned earlier when we talked about the volatility of cat bonds being around 3.5%. The thing about cat bonds is that there's no volatility until there is one. You have no losses. You have a straight accrual, straight line up until all of a sudden you have a large sell-off in your portfolio. And so standard deviation metrics is not the best approach you can use to build your portfolio. What you could use on the other side is a different approach, looking at tails, looking at, for example, how's the maximum tail I have in my 60-40, in my equities and bonds, and how are the tails I could potentially have in a worst case scenario in cat bonds. And based on tail and maximum amount of pain you could have in your portfolio, you can decide on the allocation, on the ideal allocation, depending on your level of risk tolerance. But certainly an application of simply using mean variance is not ideal given the nature of this asset class, which is there's absolutely no volatility until there's one.
Prediction time. You're rules-based, you're systematic, so we're not going to hold these to you. What's the rest of the year in 2024 going to look like? We're going to get a lot of these little baby storms, hurricane season. We're going to get some big dudes. What's the outlook look like?
Well, in terms of the market forecast, it's for a busy season. So NOAA, for example, are forecasting 17 to 25 named storms. And just to put that in context, well, so far we've had 3. But the average over the last, it's either 20 or 30 years, it's 14. So this is an active forecast season. And in terms of hurricanes, NOAA are forecasting a range of 8 to 13. Long-term average is 7. So the forecast is for an active season. And there's really a couple of reasons for these forecasts. One is that we have near record warm waters in the Atlantic. If you look at the Caribbean sea surface temperature, it's something like 84.7 at the moment. There's a nice plot of it I found somewhere. That's never been seen before at this time of year. The long-term average is more like 82.5, so it's a couple of degrees warmer. So that's one driver of these forecasts. And the reason this is important, you have to think back to how do hurricanes form. They form over water. They form when you have warm, moist air. So the air rises, and as it rises, it cools, it goes outwards, and as it's cooling, it sinks, it gets sucked back in, and you end up with this cycle of circulating and would begin to rotate air. So there are two things that are important for hurricane development. One is the warm water, and the second, as we've already talked about, is low wind shear. Now, conditions are evolving in the Pacific. That means we're heading for a La Nina, which is expected to lessen wind shear. So you've really got both factors conducive to hurricane formation. And that's why these forecasts are so high. And in fact, I mentioned that we've had 3 named storms so far. The most interesting one is Beryl. It's not the earliest forming named storm on record by any means, but it's the earliest forming Category 5 on record. So it's already an unusual year.
But I also want to take the opposite side here of what Andrew just said and caveat again what we talked about already is that an inactive season does not necessarily mean big, large losses in the cat bond space for the obvious reason we talked about already, which is that active season does not mean that you're going to have hurricane formation, which going to hit insured land. They might deviate, they might go up, they might go down in the Pacific, and they might not necessarily specifically hit the part of the regions which are insured.
Very cool. Well, it's weather. So if we know anything, it'll be unpredictable. So we'll check back in with you guys as the months and years progress. This doesn't have to apply to cat bonds. So this can be anything in the umbrella world of investing. It could be crypto. You guys go to the pub after this tonight and are chatting around with a bunch of your buddies in London about investing. So it has to be an investing topic. What's something that you say, Andre or Tarek, where you blurt this out, take a sip of some warm British beer, and then everyone shakes their head and say, I don't agree with you. So about 75% of your peers in the investment professional world would disagree with. Is there a belief you have that would fit?
I have a belief. I'm not sure how widely held it is. If you think about investing, you can group it broadly into, so one way of grouping is into systematic versus discretionary investments. Both are well established and both are well respected. But I do feel that systematic investing has a way to go in terms of its coverage throughout the financial markets. And the two doors that I feel that it's pushing against are firstly where systematic meets discretionary investing. Is there more currently discretionary activity that systematic investing can embrace? And the second is liquidity. If you think of illiquid private equity type investments, is there a way of applying systematic investing techniques to these less liquid assets? And I think cat bonds are maybe a step in that direction, but I do feel that there's further to go.
Are there any particular exotic or instruments you're referring to when you say this, or is it more just kind of a in general?
I'm going to speak personally here and not on behalf of the company, but why, for example, is there no systematic manager managing a portfolio of leased aircraft? Leased aircraft are interesting in the sense that they're almost fungible. I mean, there's only 2 manufacturers. There's Boeing and Airbus. There are, broadly speaking, only 2 types of plane. There's wide body and narrow body. It's highly, highly regulated. That seems to me an ideal starting point for applying systematic techniques. You compare that to something like shipping, where there's a multitude of different ship types, capacities, cargo, maintenance standards, fuel usage, emission quality, and so on and so forth. The regulation of the airline industry, I think it makes it ripe for systematic techniques. For the avoidance of doubt, it's a personal view.
I can't wait to do an entire episode on aircraft leasing quant strategies. That's going to be on the to-do list. Gentlemen, this has been a blast. We'll put a lot of links in the show notes, listeners. So there's going to be a whole bunch of PDFs and charts that the crew has done over the years. But if they want to read more from you guys, listen more, where do they go? What's the best place?
Best place for us is the Man Institute. It's a collection of research academic papers on various topics, on trend following, on catastrophe bonds, on cryptos. And it's one unique place which you can go. You can click on quantitative, systematic, and you get all the relevant articles that we, Andre, myself, and our colleagues have published.
Gentlemen, it's been a blast. Thanks so much for joining us today.
Thank you, Meb, for having us.
Thank you, Meb.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.